Let me now bring on board Funny Shekhar, fund manager with Angel Stockbroking. Funny, good morning. Thank you for joining us. Funny, we have inflation today, Axis Bank numbers on Tuesday, then we have Hero Honda and Bajaj Auto, and then on Friday, Reliance. Sort of the four factors which I have mentioned, which to your mind will influence Indian markets the most this week?
Well, the corporate results will not be will not hold any surprises. To that extent, I think the market will take its own course once those results are out, and the stock prices in all those three stocks, Hero Honda, Bajaj, and Axis, more or less discount the relatively better results that they will bring. I think the joker in the pack here is inflation, because this will be the last inflation print, at least in the public domain, that will supposedly guide RBI in its July 31st monetary policy. Not that the street is expecting any great rate cuts on 31st July, but what we need to know is what this inflation holds in terms of its subcomponents, and consequently how does the RBI read into it, and what kind of guidance does it issue to the markets in its 31st July monetary policy statement. So I think that is what is more important for the markets, at least from a near to medium term perspective.
Funny, what about the IT pack? After what we've seen from Infosys and TCS, do you think the sector as such is in underweight, or do you think the valuations are attractive for a buy on Infi?
Valuations, especially after this 8 to 9% correction on Infi, are attractive, and I won't deny this. However, would somebody need to go out today and buy is dependent on what kind of an investor you are. If you are more of a tactical investor who is more into timing of markets, then Infosys may not be a great buy at this point in time. But for a portfolio investor who is always looking at longer term opportunities, this is a good opportunity to accumulate more of this stock. As far as the larger IT pack is concerned, it cannot be an underweight simply because of the currency tailwind that you have. So while it is correct for the analysts to look at the dollar revenue growth, because it talks about the sustainable revenue, sustainable business trajectory of the company. What is also important in cases like Infosys, where there is a huge cash chest, is if you have 3 or 4 quarters of this rupee windfall because of a weaker currency, then it opens up that much more opportunity for corporate action like buyback or dividends, something that you have not seen in any of the large four IT companies. So that's the window of opportunity that you have for the larger IT companies. As far as the mid-cap IT companies are concerned, some of them tend to have got their act together, especially when you look at the rupee earnings, like a Mindtree or probably going forward Hexaware. But what is important is the dollar revenue growth is still not showing the kind of signs that you would look at many of these companies which are in self turnaround cases. So I would caution investors against being very favorable to mid-cap IT companies on the back of low valuations, but rather focus more on larger IT companies, especially after correction like Infosys.
Funny, so tactically, how are you positioning your portfolios at the current juncture? Where are you taking some chips off the table?
Well, there are no surprises in the environment, so to say. So while we have been underweight incrementally on the infrastructure space and the metal space, so that position continues. So there is nothing in the environment that has changed drastically for us to go overweight on them. While traditionally we have been more constructive on banks, especially private sector banks, or pharma or auto, even that position continues. So, I do not see that anything has drastically changed in the environment in the last 2 quarters for us to merit a change in portfolio strategy. So we continue to be favorable on the export-oriented stories like pharma, IT, the market weight. We continue to be constructive on private sector banking and auto, especially two-wheeler stocks.
Funny, how would you approach auto stocks now? Most of the auto stocks have corrected. In fact, two-wheeler stocks have corrected a good solid 15% from the recent highs. Most of the four-wheeler stocks have also corrected more than 15% from the recent highs.
Well, generally, one is more constructive on the auto stocks as compared to, say, the rest of the so-called rate sensitives like infra. So the pecking order there will be banking and then auto. Now within that also, I think two-wheelers will be the preferred picks for the simple reason that in spite of a poor monsoon, we don't expect the rural consumption story to slow down very materially. And if you look at stocks like Bajaj Auto as compared to say 3 years back, they have a very diversified revenue mix these days. So I think valuations are also, since they are favorable, two-wheeler stocks are the preferred pick. Now, if you go to stocks such as Maruti, there is a problem with a very high market share of around 45% that Maruti has been struggling to defend. So in that scenario, it is very difficult for them to pass on any increases either because of commodities or because of depreciation in rupee, not to mention the increase in excise hikes. So they are banking a lot on the on product mix variations. That has its limitations, but to a very limited extent. So I don't know whether, because a section of the street is expecting EPS in the range of 90 to 100 rupees for Maruti this year. I'll be very surprised if they can attain that. I think they will be somewhere around the 80 to 85 rupee mark in the best case scenario. And that to me is a little difficult for them to justify valuations above 1300 rupees. So Maruti, I'll be a bit cautious and look at buying more on declines rather than current levels. As far as the commercial vehicles are concerned, since the India investment capex story is yet to pick up in any significant way, although the valuations look very interesting, it may not be, at least from a tactical point of view, a good time to buy. However, for longer term investors, these are stories like Tata Motors or Ashok Leyland, especially Ashok Leyland is a good story to keep buying on decline so that you accumulate that stock in a range of 20 to 24 rupees, so that as and when things start moving well, there is a reasonable upside on your accumulation price.
Funny, after what we saw from HDFC Bank, what's your expectation from Axis Bank this week?
Well, I don't expect any material adverse developments on the asset quality side. That is what we are mainly looking at an entire spectrum of private and public sector banks. There can be some variation in NIMs, although to a very small extent of 20 basis points on either side. Apart from that, I think results will be more or less in line with what the street has been expecting, and to that extent, I think the valuation is also justified. And in the current environment where visibility is a big issue, these kind of stories, I guess, would always trade at a little bit of premium. So investors should not be very mindful of these stories, but rather get into them.
Do you think TVS could be a good contra bet, more like a mid-cap but high risk, high return idea? It's got 13% market share of the Indian two-wheeler market, and it is trading at a P multiple of less than 10 times.
If you had asked me this 2 years back, I would have said yes, but with the recent aggression of Honda, TVS seems to be the biggest loser there, with Honda and Bajaj Auto vying for the second or the third spot. Although in overall sales volumes, Honda is clearly number 3, and it has actually dislodged TVS from that place. So the actual turnaround story in TVS, where it had remarkably outperformed, was based on the fact that TVS had got its act together, its operating margins had stabilized, its sales mix had stabilized, and it had shown a gradual improvement, although a stable improvement, for 4 to 6 quarters, which actually helped the market re-rate the stock, and that's exactly where you saw TVS hit its lifetime highs. But after the entry of Honda, I think the market is now increasingly getting wary that TVS might slip back to those older days, although it's too early to say, and we hope it will not happen. But that is what is reflecting in the valuations of TVS. And wherever you saw that, for example, TVS registered a spectacular rally in the last couple of weeks, it was based on the fact that on the rumors in the market that they might get into some kind of a technology arrangement or a JV with a stronger partner. So if TVS gets into any of those kind of arrangements and the market gets a sense that it can get its act together, then you might actually see a more resurgent and stable rally in TVS. If it doesn't happen, then I think TVS will be a more volatile stock.
How exactly are you approaching currency sensitives?
Well, I believe that currency, at least in the near to medium term, might appreciate back to around 54 to 55 levels. I see that revisiting its previous lows of 57.20 is a distinct possibility. At the same time, I do not expect the pressure that on the currency to abate. What it means is, I do not expect either a very material appreciation back to 50-51 levels, or at the same time very material depreciation. So you will be in the 54 to 55 range with a slightly downward pressure as long as oil hovers at around $100. Now, if oil were to correct, and if there is some respite in the global rally in the dollar that you are seeing, then there might be a little bit of respite for the currency. But overall, expect currency to be in the 54 to 55 range for the better part of the year.
Funny final question. For last 15 days, the Nifty has been stuck in a 100-point range. When do you think we will snap out of this range?
Well, I think that's a very difficult question, which you reserved finally. I guess a lot depends on what happens post-presidential elections from New Delhi, because a lot of there is a battle of perception that is going on, and at least New Delhi has started by scoring some brownie points, which explains the rally from 4800 all the way up to 5300. Now, I think in order for this rally to continue and the market to break out, a lot will depend on the policy initiatives and not so much on what kind of results that the market generates.